Welcome to the Center for Investment Excellence, a production of JP Morgan Asset Management. The Center for Investment Excellence is an audio podcast that provides educational insights across asset classes and investment themes. Today's episode is entitled Maintaining Conviction Through Disruption and has been recorded for institutional and professional investors. I'm David Lebovitz, global strategist and host of the Center for Investment Excellence. With me today is Danielle Hines, U.S. Director of Core Research at JP Morgan Asset Management. Danielle, welcome to the Center for Investment Excellence.
Great. Thank you for having me. Happy to be here.
Well, we are super excited for this conversation, and I know we're going to tackle a lot of things related to equity investing and the process and so on and so forth. But before we get into those bigger picture topics, let's start with what the architecture of U.S. core equity research looks like at JP Morgan Asset Management. What are the core components of the framework? What makes it different from other shops across the street?
Sure. Yeah, I think it really comes down to a few things in my mind. The first and probably most critical is just how we've structured this role. So we've structured the role to be a career research analyst role. It's not meant to be a stepping stone to portfolio management. It's really meant to be a career. And what that means is, we have a tenured team of senior research analysts with on average 25 years of experience covering their sectors. So they've seen cycles, they've seen structural change, and they've built relationships across their industries for decades in many cases. And so we think this really allows us to sort of navigate these periods where we're seeing, of course, a period like today, a lot of change. The other thing I'd say is just a focus on the long term. Mm-hmm. So our analysts are thinking about, they're forecasting out 5 years of earnings and even thinking longer term than that. And our philosophy is that we can take advantage of mispricings in the market relative to our view of long-term earnings power. And I'd say in order to assess those mispricings, we have a valuation framework that we use. It's a 5-year expected return framework. We've used this for close to 4 decades. So it really is a time-tested investment approach that really helps us to not only find opportunities, but have sell discipline as well.
And I think that's really 2 key things there that jumped out at me. 1, the duration that this has been in place, and 2, the discipline that is kind of shaken out of the process in terms of buying and selling, which, when markets are moving as quickly as they are today, obviously becomes that much more important. And
totally.
We'll talk a little bit about how the process has evolved over time as tools have changed and information, again, has been flowing more quickly. But you mentioned that you have this process built around a 5-year view. I've always been of the opinion that when the near term is really hard to see, looking longer term makes a lot of sense. So you have this 5-year view in a world like it's changing every 5 minutes. So the question that we keep getting asked is, how does our equity team, how does our equity platform know when you're early versus when you're wrong because you're taking that 5-year view? And how does the process help you know which of those you are? Are you right or are you early, or wrong or are you early?
Yeah, no, oh my gosh, this is such a good question and something that we ask ourselves all the time. Mm-hmm. Like I said, we're using duration to our advantage and we're taking an 18-month to a 36-month view. And so in some cases, we're going to be early. And so the key is understanding, to your point, when are you early? When are you wrong? Our research analysts, not only are we doing those forecasts, we're also writing down, what is our investment thesis and what are the things we're looking for to tell us whether or not we're on track. And that helps provide a framework for us to really be able to assess. But I'd say, in periods like the one that we're in right now, we have new information coming at us every single day. What you do is you roll up your sleeves and you do the research and you're evaluating, are my earnings forecasts really the right probabilistic earnings forecast today based on what I know, or do I need to adjust? And so that's something that we're constantly doing as a team, and happy to walk through maybe an example if that helps bring it to life a little bit.
Yeah, I think an example would be great, but the one thing that I'm hearing is you stay humble, right, to the process, and you're not digging yourself in when there's new information. It's like, well, when the facts change, I reserve the right to change my mind. So let's use an empirical example to talk a little bit about this. What better than AI, because that's all we talk about. every single day that we're here. Let's start with companies that are facing disruption. So the AI disruptors. How do you think about assessing that, and practically how does it get into the numbers when you have that kind of disruption risk?
Yeah, so I mean, the market's clearly been indiscriminate
Yes.
in terms of derating perceived AI losers, not only in software, but as we know, across so many different sectors within the market, whether it be, any business services companies, wealth management, the list goes on and on. And I think it's so important that we have this tenured team to help us understand industry structures and understand, like, where are the moats and where are the risks real. And so you can imagine over the last 6 months, we've been doing a lot of rolling up our sleeves and trying to understand this. I think a good example to highlight some of the work we've done is actually insurance brokers. And, Aon and Arthur Gallagher are names that we own in some of our strategies. And the market has put them in the perceived AI loser bucket. And the reason is the market says, well, if you're matching buyers and sellers of insurance, why can't an agentic solution do this?
Right.
And we really think the market is missing a few key things. One is just the extensive amount of proprietary data that these insurance brokers have and how much value that is for their customers. And it enables them, to have AI-driven pricing and coverage optimization. The next piece is just the distribution and, the existing client relationships that they have. Right. And then the final piece is really like the complexity of not just, placing insurance, but the claims process and the ongoing piece of it as well. And I think just to give you a bit of insight into the work we've done, it's not like we just, have this view and, we have all this new information coming and we're not digging in. Our research analyst, Brent, who's covered the insurance companies and the brokers for quite some time, we set up a series of meetings. We met with some of the companies trying to disrupt the insurance brokers. So Brent actually goes to an InsurTech conference every year. He's probably one of the only long-only investors that goes. And he meets with a lot of these companies that are trying to disrupt. And so we've brought in some of the disruptors to see their platform and ask them questions. We also then met with the insurance brokers that we cover to see their technology platforms and understand what really are, the competitive moats that they have. We've met with consulting companies. Brent was actually just this week at a conference, an insurance conference for insurance executives, but he was there and seeing some of the platforms and demoing them. And we then had a follow-up with the CEO of one of the insurance brokers, and he was shocked that Brent was at this conference. But it just gives you a sense of some of the primary research that we're doing to then get conviction in the view. And ultimately, in some cases, more conviction in the position. And that's one example where we've done the work and feel confident that they will not be disrupted by AI. But there are other examples where we have varying degrees of confidence. And in those ones, we've probability adjusted our forecasts and our terminal values as well, because we want to make sure the valuation signal that we're getting is one that we can really lean into if we're getting the signal.
And I think the other thing that's really interesting about the example you just laid out is you're not going to find that in a research report, right, that gets sent to your email inbox. Like, you actually have to go out there, boots on the ground, do the work, and it sounds like that's something that you're really doing to build conviction. So we talked about the disrupted. Now let's talk about the other side of things. So the AI enablers. It feels like some of these names go up every single day. Like, NASDAQ is giving me vertigo over the past couple of weeks. So when you have these stories that are in the market, right? And I think we all believe in the AI story over time. How does the framework stress test whether you're underwriting like something that's real and is going to have a positive and durable impact on earnings power, or is it a cycle that fades? And how does the process operate when you have this kind of euphoric consensus around an idea like we're dealing with today?
Yeah, no, I think it's such a good point. And I think for us, starting point, the process is the same. It applies to both sides, right? It applies to
That's why it's a process.
The one side and the other, totally. But I think what's important here is that we cannot be afraid to adapt to new information and change our numbers when the facts change.
Yep.
And I think, the AI enabler bucket, as you call them, is such a good example of this because, even versus a year ago, ourselves and the market, we underestimated the amount of AI spend. We underestimated, we were sort of framing it in the lens of hyperscaler free cash flow.
Right.
And we've obviously seen much more than that for all the reasons that we know. And so as a result of that, we needed to adapt and adjust our numbers and make sure that we had like the best thinking in the numbers. The way that we get comfortable with our framework for the long term is also through the collaboration and partnership that we have across our equities team. So, for example, our utilities analyst has become the most popular person on the floor. I think you had her on one of these podcasts,
exactly.
right? And she's collaborating with our industrials team, with our technology team to understand where are the bottlenecks, how much power can come online, what does that mean for AI spend, and then ultimately what does that mean for the enablers. So we're really spending a lot of time as a team together to get that cross-sector knowledge share going to help us make better decisions even within sectors.
I think it's such a good example of how you can take a single process and apply it to the evaluation of different ideas. And I think that, again, the consistency that integrates into what you're doing every single day is what you want from an active manager. My first job out of school was manager research. I understood that managers were going to have good times and bad times, but what I didn't want them to do was change the process when things weren't working. And so you have one of the most tenured research teams in the industry. You said earlier, 40 years, 4 decades, this process has been in place. This cannot be the first wave of disruption that you've managed through. So can you talk to us a little bit about during previous times where you've seen this type of disruption and this pace of change, how has the team navigated it and how is the process applied?
Yes. So there are definitely examples that I could pull from, but I think one that, like, particularly the perceived AI loser piece reminds me of a bit is e-commerce. And when you had the rise of Amazon, the market derated pretty quickly, pretty much every brick and mortar retailer.
Yep.
The view was, well, why would you need any of these companies? We just have Amazon. And then you look today, and what ultimately played out is you had winners and losers. You have some retailers who effectively went away. You have, Bed Bath & Beyond. Department stores look different today than they did before. But then you have companies who adapted, they innovated, they used their scale to be successful in an omni-channel world, which is ultimately what the consumer wants, right? And so I think when we think about sort of AI disruption today and we look out the next 5 years, we'll probably be in a similar camp where there will be companies that don't exist that exist today. But there will also be companies, the incumbents, who adapt and innovate and use their distribution, use their proprietary data to be successful in whatever the world looks like 5 years from now. And so our job as active managers, to your point, is figuring out which one of those companies are going to be the ones to get up to the other side. And we're finding some really interesting opportunities when we think about, not just in areas like software, but like I talked about insurance brokers, in areas in like Autodesk, which is a construction design company. Like a lot of these companies that we think have real moats are names that are starting to look pretty attractive for us that we're excited about.
So I'm a credit guy at heart. So I always think the glass is half empty. So I'm going to play devil's advocate for a second. Going back to the e-commerce example, that was like one piece of the broader economic pie. It feels to me like every AI is touching every sector almost simultaneously. So isn't that kind of a different animal? Like, should I say what we're not supposed to say? Like, is this time different? How do you think about that?
No, I mean, like, to give you a sense, I was talking to our commodities analyst recently, and he was telling me that in this time, when everyone was getting concerned about e-commerce, he was being asked to write a report on the B2B commerce impact on energy companies. And this is something, he was on the sell side then, and this is something that was being done across every single sector then. And we know some industries were really disrupted and others were not. And so it's kind of hard to imagine that that's what was happening then, but it was. And I think we may be in a similar place today.
Well, I mean, it certainly feels like it's like which sector is going to be in the crosshairs of AI
Totally.
today.
It feels like whack-a-mole.
The way I feel walking into the office. I know we actually have the local town fair this weekend, so I'm sure I'll be playing some whack-a-mole with the kids. But so the one thing that's coming out to me is that, change is constant. And you've talked about how the process incorporates new information and the team has effectively navigated disruption before. Does any of this change, the tools that the team is using or how the team itself is built? Like, does anything change or is it just the same thing over and over again?
So I would say in terms of the core, this is a people business. Yeah. And our competitive advantage, I believe, is our team. Yeah. Our tenured team that I started with, who, they have decades of experience. They're focused on understanding who are the winners and losers in their sector. They're understanding structural change and developing insights that help us generate alpha in our clients' portfolios. And that, I think, is the secret sauce of everything. Now, that being said, there's so many awesome new tools that we can use to augment the analysts, to help them ensure we're covering all the bases, not missing any. There's so much information coming at us every day. Right. And we've already started to implement, actually, some pretty interesting tools for the team, not just to help with the efficiency side of things, although that's important, but also to help us on the investment decision-making side of things. And I think that's an area where we're going to continue to work with our data science team to build, but we already have some really interesting tools. And I think, Jensen says it best. Jensen from NVIDIA, he says, AI is not going to take your job, but the people who use AI will. And we're fortunate enough to have the scale that we do to be able to invest in these tools for the team.
And I think that your point about people is even more important with the advent and the adoption of these tools than perhaps it was 5 years ago. I mean, I remember coming out of college, I was a political science and philosophy double major. It's like, do you want fries with that? What am I going to do with these degrees? But so much of the programming and the math and kind of the data science, right? It's now easily accessible. And it's about knowing which question to ask. Like, that's the most valuable skill. And I go back earlier to your example about the insurance brokers. Like, that type of research that can't be replicated by the rest of the street is something that gives us the edge to ask the right question and really benefit from the incorporation of these tools. And so, I mean, it sounds like it's a process that has stood the test of time, but there is a dynamism to this process that incorporates new tools as they become available. And so, at the end of the day, it sounds like this framework gives you three things: a common language, you got the valuation discipline, telling you when to get in and, more importantly, when to get out. And the team has, the pattern recognition to know the difference. And so thank you so much for joining us today. This was a lovely conversation, and we'll have to have you back sometime again soon.
Yeah, happy to be here. Thanks for having me.
Thanks again. Thank you for joining us today on JP Morgan Center for Investment Excellence. If you found our insights useful, you can find more episodes anywhere you listen to podcasts and on our website. Thank you.